experts like me research and find the mutual funds from different categories, from the 5,000 plus mutual fund schemes that are out there, and how do we shortlist the quality schemes that we can recommend to each client. Now, once again, let me remind you that this selection is not a general selection for everybody. It changes based on personal choices, risk profiles, family background, education, and lot of other factors that we will talk about in this workshop as we move forward. And 50% of the professional work goes into avoiding the bad choices. It's not sufficient to just know what is good out there. It's also important to know what you should avoid deliberately, so that you can keep your portfolio clean and stress free more than anything else. So in this workshop, what we are going to do is uh, what are the factors that lead you to make bad choices, bad decisions, and pick up bad funds in the market, and how does your goal maps to a mutual fund category. So if you have a certain type of goal, which mutual fund category is the best choice for you, and so it basically makes it easy for you to narrow down your choices and not spend a lot of time confused going from one point to the other. And then we also will also share a 6 point fund checklist that you can go on to analyze all of the funds and to select the best ones that fit your agenda and fit your goals, and the red flags obviously that you can identify in the beginning and avoid those funds. So let's start. So before you get into the market and search for, so this is mutual fund shopping is not kind of mutual window shopping that you do in a mall where you just enter without a goal and try to find what feels most attractive. Mutual fund shopping is scientific homework. The better your homework is, the better your choices will be. So, how do you do homework is basically with these three simple steps. First of all, you need to be aware of your goal. Whether you're whether you keep creating an emergency fund, or you want to look after your child's higher education expenses, whether you are planning for a vacation, whether you just want to create a lump sum amount like 1 crore or 2 crore corpus, or you are collecting funds for starting your own company or your own business, or simply put preparing for retirement or home purchase, and lot of other things. But at the in before you go ahead and search for mutual funds, what are the best mutual funds for your goals, you need to be very clear about your goal, and how much clear is, you will see. Second part of that that clarity is, when will you need that money. So whenever you are planning for a goal, it's not just about retiring or buying a house. It also tells you, when do you plan to buy a house, when do you plan to retire, if you are planning to retire at 55 or 60 or maybe 40 even, or when do you plan to start the business, at 35 or at 40, or just in 2 3 years. So accordingly, your choices will change, and you will see how it will change. If you have been investing, you are already aware of these overviews, so we'll not spend a lot of time on these things. But these are the very basic foundations of your choices. If the foundation is wrong, if you are going for retirement and you end up choosing a fund for a couple of years uh, down the line, maybe 2 3 years down the line, that choice is not the best choice that you can have for retirement goal. But if you are going for a small short term like 3 to 5 year goal, like home purchase, and you end up choosing a fund that is very high risk and requires 7 plus years of investing, then your patience will run out and you will be forced, more likely to be forced to lose out on your money. So what we want is, we want to reduce these forcible decisions. these that you are compelled to pull out, or you are compelled to invest, or you should not be compelled to do anything except meet your goals. So you define your goal, when you are going to achieve, when do you want the money to come into your account. Second thing you want is you want to quantify the goal. You have an income, you have a certain lifestyle, and accordingly you quantify your goal, whether you want it to be 1 crore, whether you want it to be 10 crores. Accordingly your choices of vehicle, the investment will change. Third, which is a this is a very difficult question to answer if you have not experienced the market firsthand, is that if your portfolio declines by a certain percentage, how will you react? A lot of people would, almost nobody would want to have their portfolio reduced by a certain percentage. If you are investing 1 lakh, you expect to receive 1 lakh 5,000, if not 1 lakh 10,000, but you will never expect to receive 90,000 out of it. So this is basically a generic question, you can say, which defines your mindset, which will give you an idea whether you are comfortable with this kind of situation, or whether you know how do you react emotionally to this kind of situation. So why it is important, we'll see. So uh, the first part, once you have decided, okay, this is the goal, then second thing comes in, okay, this is going to be the timeline. I want this goal, I want to achieve this goal within 5 years, I want to achieve this goal, I have 7+ years for this goal. Accordingly your choices change. So if you see in here, uh, these are my choices. uh, Other mutual fund advisors may choose differently, but that will be their choices, and that you can ask why any point of time. So 1 to 3 years is, uh, basically you are going for a very safe investment, not volatile at all. So you're going for ultra short term funds, or liquid funds, or money market funds, which are not going to be investing aggressively or losing. You will never lose money in these funds. Another part is, okay, then 3 to 7 years. In 3 to 7 years, you are looking at aggressive hybrid, balanced advantage, conservative hybrid funds. So these are basically balanced funds, which are some have a large portfolio into equity, but also a very significant part of portfolio is allocated to the debt or fixed income instruments or government securities. So they are also little bit flexible when it comes to the market situation and the portfolio structure. So if the markets are not that good, equity markets are not that good, they will increase their exposure to debt and reduce their exposure to equity, so that your risk also remains low. So markets will be very volatile, these funds will not be as volatile. Second, and the third part is, if you have 7+ years of time with any goal. Generally, these are retirement goals or any long-term goals like second house purchase or something. These goals, you can be as aggressive as possible with these goals, depending on the timeline. So if you are like 7 years, 7 to 8 years, I can go for a large cap fund for you, or I can go for a flexi cap fund for you. If you have 10 years plus, then I would go for thematic and even uh, very aggressive funds, value funds also. Index fund also falls into 7 years. ELSS is also not very aggressive, but it's all equity, so it's more risky than hybrid funds and debt funds any point of time. So there are different categories of equity mutual funds also, where you can have lower risk, more dividend income, more dividend paying stocks in the portfolio, or value stocks in the portfolio, or a sector specific stocks in the portfolio, or even you can go for fund of funds which are investing in foreign markets. based on your risk profile. So risk profile is not just the time itself. Time I'm discussing because uh, there are multiple people on the who will be watching this. So a personal risk profile is also a part of this choice. It will be based on a mix of the time you have and what your personal risk preference is. If you're not comfortable with equity at all, I would not say that you should not, you can avoid equity. Equity is inevitable in the portfolio. If you are avoiding equity, inflation will put your lifestyle down aggressively, very, very harshly. So, if you want to beat inflation, if you want to stay ahead of inflation, gold is not enough, debt investments are not enough. Equity is the only instrument that beats inflation over a long period of time. And I'll show you. It's not that I'm making this up. I can show you, and you can also nowadays it's very easy to search on Google. You can also see that with a simple Google search, and we'll go through that also. So, how we select the fund is basically first of all we find the category. This is a top-down approach. We find the category, and within that category, first we decide which category we want to address, and that you saw uh, with the time. Time is a major factor defining the category, but there are also other factors, and that you see here also. Return consistency is what you will see based on the length of time you want to invest to. Like if you want to invest in a for a 7 year or 10 year horizon, you want to see a consistently performing fund. So you would want to see a fund that has been performing consistently for at least 3 to 5 years. And why it is important is because if the fund is very volatile and it's the performance, so how do you volatility is not basically the uh, parameter to judge the performance. We judge the performance based on the funds returns, funds ROI compared to the benchmark ROI. If the benchmark is consistently below the fund returns, fund is beating the benchmark consistently over 3 to 5 years, then you can comfortably park your money here and wait for another 5 to 10 years. And it's not like we are going to leave it like that. We will also continuously review every year. So we'll know if the fund is not performing that well, we can switch over. But in the beginning itself, we don't want the fund to ditch us in the within the 6 7 months period. We want the fund to consistently perform, and we don't want to switch before our goal return before our goal is complete. So we want a consistently performing funds, and that consistency is looked at by comparing the funds return with the benchmark returns. Then third part is the risk behavior. So risk behavior, to check the risk behavior, we look at the certain ratios for the mutual funds. These ratios are declared by the AMC for the fund. Any fund which has been performing, which has been running for more than 3 years, will have these ratios declared. If they are running for more than 3 years, also you can find the ratios for 3, 5, and 10 years like this. So to check the volatility, there is a standard deviation you can look at. There is also Sharpe ratio that you can look at. There is also a beta that you can look at. Beta is the relationship with the market. Now we'll discuss all these parameters in detail later in the presentation. Another thing is, so once you have selected couple of funds which are fitting in the first three categories, then you start finding. So far we have only finalized the categories. We have not drilled down to the AMC and fund manager level. And this is where the you are picking you are still picking the category of funds. You are deciding whether you are going for mid cap, flexi cap, large cap, and then you come to the cost. You can also decide whether you want to invest in an actively managed fund or a passively managed fund, index fund. And then you come to the cost. Cost is where you decide, okay, if there is a very high expense ratio of let's say 1.5% or 1.25% or maybe more even. So this happens when the fund is very popular. Everybody wants to get into the fund. Like defense funds have been very popular these days. Uh, they have to ultimately close the investment for a while. They could not take additional funds. And then, so what you look at, the cost is defined by total expense ratio. So every fund will declare this total expense ratio. You can very easily find, either Google it, or you can go to any website which will, you can also download, visit the AMC website to find the total expense ratio. Few things that people usually miss is, in the excitement of investment, is exit load. What happens is, most of the equity funds especially will put an exit load over 12, if you are withdrawing before 12 months. So if you're not aware of, or if you're not conscious of this exit load, you might end up losing the ROI that you have generated. Sometimes if your fund has performed very well within a year after investing, and you are fearful of losing out that streak, that fund per NAV will come down and you will lose the return. So you want to secure it and you want to withdraw before 12 months. There is exit load in the fund. Then it will affect your return. So before you invest, make sure you know whether there is an exit load and how much exit load is there in the fund. Usually, the equity funds will have an exit load before, if you are withdrawing before 12 months. It's not very high, but it varies fund to fund. So do check for the exit load. And TER is the total expense ratio. So it includes everything except for exit load. So that is there. Now, fund manager and AMC, reducing the result, performance of fund manager is basically, uh, if you remember, we talked about return consistency and additional performance, excess performance of the fund over the benchmark. So fund manager's performance is judged by certain ratios and history. So you can search about fund managers' history. If they are not new, generally they will have 4 or 5 years of experience of managing different kind of funds. The kind of AUM they are managing, you can very easily find out, and the kind of funds they are managing. So not every fund manager is managing all kinds of funds. So certain fund managers are specialists of certain kinds of funds, and certain so few fund managers will be very good at finding value investments. So they will be a very good fund manager for value funds, but not that they will not do very good with the dividend stocks or large cap stocks. Other fund managers will be very good with the mid cap and large cap. You can say large cap stocks which are right about entering the index. So they will be very good at picking up these stocks, but they will not be very good at other sectoral stocks or sector specific markets or foreign markets. So there, so you can find that their history and find who is managing the fund, who is basically the leader, and then narrow down your choices accordingly. Also, remember, if the fund manager is very popular and there is a uh, popular fund he is managing, the TER is usually going to be high. So I'm not saying that is a negative, but we do have to look at multiple other factors also. If that is the case, we want to see if the expense is rewarding enough to enter before investing in that fund. And then we check the, finally you get into the portfolio quality. So portfolio quality is this. There are certain thumb rules that you can very easily remember. One of the thumb rule is, it should not portfolio should not be very heavy. Like it, it cannot have more than 30 stocks. 30 stocks is a is a sweet spot, easily manageable. highly diversified, not too diversified. If your portfolio is too diversified, you suffer on the long-term performance. If your portfolio is less diversified, your risk goes very high for the same amount of return. So the portfolio diversity has to be right, just right, and 30 stocks is that sweet spot. Some funds may have 35, 37, but it should not be more than 50 at any point of time. So if you find a fund which is holding more than 50 stocks, you can say that this fund is not that good quality. Maybe they will reduce it later on. So you can, if other factors are really good, you can still invest in that fund. But I would say keep it at a lower amount until the fund improves. Another thing is the firms, the stocks they are investing into, how is their credit quality? If they are investing into debt funds, what is the quality of the credit? What is the credit rating? What of the securities they are investing into? If they are investing into triple Bs, double As, or triple As, or only gilt funds, gilt securities, and maturity profile. So maturity profile is given by the duration of the fund, duration of the bonds. So if a fund is investing in a very short duration bonds, that means it's a kind of liquid fund. So you will have ultra short duration funds which are investing into less than 1 year maturity profiles. And then there are long term funds. So long term funds, long duration funds, uh, which are investing in duration bonds which with duration of 10 years plus. These bond funds are more volatile. That is why they are long term. So you need to stay with the fund to actually make money, make good money. So over the long period of time, they will perform very good. But if these long duration funds you are investing for a short period of time, then you have to be a bond expert to actually make money out of them, make good money out of them in the short run. So short run duration will define. Uh, Duration basically tells you how quickly the bond is going to pay back whatever you have invested in the bond. So that if the duration is very long, the bond price will be very volatile. For every interest rate change, the bond price will move a lot. But if the duration is low, the so basically as bonds approach their maturity, their volatility goes down. So that's why longer duration bonds will be more volatile and shorter duration bonds are less volatile. So if your fund is investing in short duration bonds, then it's low risk investment. It will give you a consistent return, but uh, it's good for a short term investment, not that good for a long term choice. So, again, coming to what we are talking about, how to judge the consistency is you compare it with benchmark. You look at the 1, 3 year, 5 year, and 10 year windows of returns, and if available. So if the fund is very new, like 3 to 4 years old, then you will have only 3 years of data available with it. You can check SIP returns and the lump sum returns, CAGR of the fund, and then compare it with the peers. So when you compare it with the peers, you actually understand where the industry has been going in the. So peers are also investing in the same funds. So if same stocks. So if all the funds are not performing that well, that means industry was not doing well. So no worries, no fault of the fund manager. But if this fund is doing good, that means the fund manager has been good. So it makes sense to get into that fund. And there is always a benchmark index. So this benchmark is provided with the mutual fund document itself. So you can check that in that document. You can also search on the internet, and when you find a website like Value Research or ET Money, you will also see that benchmark given there. Category average is also a lot of websites provide, like Money Control, Morningstar. They provide category average, and you can see that. All right, coming to the risk ratios. So, always remember, uh, I always tell my clients that returns will be looking good in, and returns basically make you excited to get into, start investing, which is good. But return is not why we invest in the market, why we choose a certain mutual fund or any investment. We choose that investment because we can manage and live with the risk that investment brings. So I'm not saying we only look at the risk. I'm not saying we only look at the return, but we have to look at both of them in at the same time and compare them. So how we are comparing them is you have these risk metrics, standard deviation, beta, alpha, Sharpe, or Sortino ratio. So these ratios give you, okay, standard deviation. If standard deviation is very high, that means uh, fund is going to be very volatile. It, it actually because it is based on historical data, so it is already very volatile. Beta tells you how strongly this fund relates to the market. So if market goes 200 points up, how much momentum this fund will have gain out of it, or if the market is 200 points down, what kind of momentum this fund has it. And then alpha is there. Alpha basically tells you how the fund manager is doing. If the fund is delivering better results than the benchmark after risk adjustment, then alpha will be positive, and that positive alpha is what you want in any fund. And Sharpe ratio tells you, so basically alpha and Sharpe. So first two parameters here are pure risk ratios. Alpha and Sharpe ratio is what you want to look at to compare the risk return metric. So Sharpe ratio actually tells you how much return you gained for every unit of risk or a standard deviation. So if one fund has a Sharpe ratio of 1.2 and another fund has a 1.5, I would go with the 1.51 because I am getting more ROI out of every unit of risk I am taking with that fund. Same thing with alpha. If you are comparing two funds with in the similar category and one fund has an higher alpha, I would say go for the higher alpha. But also see if the alpha has been consistent over a long period of time. So check one year, 3 year, and 5 year returns compared to the benchmark, and you will very easily see whether alpha has been consistent or not. Cost and manager quality. Okay, so we have already discussed this. Portfolio quality check by category, equity fund, debt fund. Okay, so uh, no matter how good you are at diversifying, we can see that in our portfolio management also many a times that our 20% of holdings will be concentrated in 80% of the stocks, and 80% of holdings will get concentrated with just 20% of the stocks. This happens with the mutual funds also, not exactly in the same ratio, but a large portion of the holding will be concentrated in certain stocks. And that is also because our equity market is not that large even now. It has a lot of potential to grow. So still you will find certain stocks in almost every mutual fund, every equity mutual fund, because these stocks are so big that everybody can invest in them. Second thing, we don't have a lot of choice. Then there are certain sector bets like BFSI is everywhere, almost everywhere. Whether you go into large cap, any large and mid cap, any flexi cap, these BFSI stocks will be there. Then there is okay, some mixed consistency is also something, but you will very easily see that you should compare this with the fund's objective. If the fund is saying I invest only in large cap, but there is a mid cap mix in the portfolio, then probably something is wrong with that fund. It will be corrected over a period of time, but right now it may not be a good choice to enter that fund if that fund is not consistent with the fund objective. Style drift versus category name, same thing. So, credit quality of instrument, we talked about this. Liquidity of portfolio papers, it's the same about. Uh, so, liquidity of portfolio papers is also going. It's basically liquidity is judged by the credit quality, and how easily which kind of. So if you are investing in more into government securities, they are very liquid. If you are investing more into private securities, private money market securities, if you are investing in more into money market securities, your liquidity will be very high. But if you are investing in triple B rated bonds or lower rated bonds, then your liquidity will be lower. Whether portfolio matches stated low risk promise, again, same objective matching. If the objective is not matching the portfolio, then avoid it. So we can do this. Let's see. Let's go to you can go to even we don't have to go there. Let me first show you what happened in the market. So 50% is your ROI. And it goes to 5 years. At this moment, from something about 15,670 to 23,366, the market has given a consistent CAGR of 8.5% approximately. Over a long period of time, oh, that's where 1999. That's obviously it's going to be much higher. Now coming back to the mutual funds.